Ladies and gentlemen, good day and welcome to VARROC Engineering Limited conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vasudev Banerjee from ICICI. Thank you, and over to you, sir.
Hi, thanks, Ryan. Good evening, everyone. Thanks to VARROC Engineering Management for giving us the opportunity to host the Q4 FY22 result Concall. We have with us Mr. Tarang Jain, Chairman and Managing Director, Mr. Christian Peschel, CEO of VARROC Global Lighting, Mr. Arjun Jain, Whole-Time Director, VARROC Engineering, Mr. T.R. Srinivasan, Group CFO, and Mr. Bikash Dugar, Head of Investor Relations. I'd like to hand over the call to Mr. Tarang Jain for his initial comment. Post that, Ryan will coordinate for the Q&A session. Over to you, sir.
Yeah. No, thank you, Mr. Vasudev Banerjee, for hosting the call, and good evening to everyone. I would like to thank you for joining the Q4 FY22 earnings call of VARROC Engineering Limited. Looking at the past year, while we were all anticipating a rapid recovery in volumes, the second wave of the COVID-19 pandemic struck, impacting both the supply and the demand side. Just as we were coming out of the second wave, we saw a worsening of the supply side challenges, particularly the semiconductor shortages, which is continuing and might take till the end of FY23 to get normalized. The higher fuel prices, commodity inflation, and tightening of financing has resulted in higher cost of ownership of vehicles, impacting demand. We are also witnessing geopolitical issues like the Russia-Ukraine conflict impacting the global economic recovery. All this has made the operating environment for the business very challenging, impacting the profitability of the operations significantly. In the background of these challenges, the company took the decision to divest its four-wheeler lighting business in Europe and the Americas and signed an SPA with Plastic Omnium for an enterprise value of euro 600 million in April 22. The transaction will take 4 to 5 months to get completed, as we need approval from the shareholders, the regulatory bodies in various geographies, and also from our lenders. This divestment will help the company strengthen its balance sheet and invest in identified focus areas to drive future growth. In our financials, the business which we are divesting is now accounted for as discontinued operations, and only the profit and loss from discontinued operation is shown as a one-line item in the income statement as per the accounting standards. In India, the auto production for two-wheelers in FY22 fell by 3.5% despite a lower base of last year due to the weak rural demand and the higher cost of ownership. Passenger vehicles in India rose by 19.2% due to the preference for personal mobility. Commercial vehicles and three-wheelers also witnessed growth due to the lower base and overall economic recovery. On the backdrop of all this, the revenue from continued operations for FY22 has grown by 33.6% to rupees 58,442 million as against rupees 43,739 million in FY21. Outperforming the industry production numbers. The EBITDA margin for FY22 was 6.1% as against 7.7% in FY21 for the continued operations. The margins were impacted by higher commodity prices, forex losses on intercompany loans, and a lower operating utilization in some of the geographies. The revenue for Q4 FY22 for continued operations came in at rupees 16,520 million, which increased 11% quarter-on-quarter and 9.8% year-on-year, again outperforming the industry production numbers. The EBITDA margin improved on Q-on-Q basis by 150 basis points and came in at 6.5%. The margins for the quarter are still impacted by higher raw material prices. The focus of the company remains to pursue strategy, which is a combination of growth and margin improvement for our various business units. We have growth opportunities due to the mega trends, and some of our business units like electrical electronics in India, our polymer business in India, the electronics business in Romania are geared up to capitalize on specific growth opportunities. We are looking to improve the profitability of some of the business units like EMES, forging plant in Italy, and our metallic business in India, the four-wheeler lighting business in India, and our two-wheeler global lighting business by a mix of improving internal efficiencies, higher capacity utilization, and in some cases, price increases from our customers. Strong order wins for new businesses in FY22 across business units will enable us to continue to outperform the industry growth and will also help us in improving the profitability. During FY22, lifetime revenue from new order wins is at rupees 35,509 million. And out of that, the business win from the EV customers is rupees 10,451 million. To capture the growth from mega trends, we're happy to announce that the government has approved our application for product-linked incentives, and we will be investing around rupees 2,800 million over the next 5 years under the scheme. I am now handing over the call to Mr. Srinivasan, our Group CFO, so that we can run through the presentation, which is already uploaded in our website and in the stock exchange also. Thank you.
Thank you, Tarang, and thank you, Basudeb, for hosting us today. We had uploaded our presentation a short while back. I will just quickly touch upon the highlights from the presentation, focusing on the financial part. Then we will leave the field open for questions. Starting with the highlights of the last quarter and year. So the biggest highlight obviously was the securities purchase agreement we signed with Plastic Omnium in April, which you are already aware of, and we had a separate call on that as well a few weeks back. The second is about our application for under the PLI scheme, auto components sector, which has been approved by the central government. So we'll be investing close to 280 crores over a 5-year period. And the other highlight is that from a revenue perspective, both in the quarter and year to year, we have grown. Part of the growth is related to commodity price inflation, and part of it is due to better capacity utilization and additional orders we are able to get from customers. And also sequentially, we have been able to improve our EBITDA margins for the continuing operations. So from you might have seen from the financials that the business, the lighting business in Europe and North America that we are planning to dispose of have been reported in a separate line in the P&L under discontinued operations, and the rest of the P&L reflects the results of the continuing operations we have. Then during the year, we also won a new business which will contribute lifetime revenues of around 3,500 crores overall, out of which revenue relatable to the two-wheeler EV segment will be in the region of about more than 1,000 crores. So these are the major highlights. We have included a slide on the overview of the continuing operation just to give a better idea to the investors on what are the businesses remaining within the company after the planned divestments. So in the VEL standalone entity, we have two business units, electricals and electronics business unit in India as well as metallic, in addition to the aftermarket division where we have seen significant growth, and the four-wheeler lighting business which will remain in India, which will remain with us. we have a number of subsidiaries in India which are mainly in the polymer business, VARROC polymer, then the metallic business and the Durowall. And coming to the overseas business, we have a joint venture in China, like you know, which is into four-wheeler lighting. And we also have a metal forging business in Italy under IMES, a global two-wheeler lighting business which has operations in Italy, Romania and Vietnam, and the electronics business in Romania, which we are retaining. So if you look at the overall revenue composition, little more than 5,000 crore revenue will come out of the businesses we have in India, and something like 1,400 crores will be the revenue generated from operations outside India, including our share of the 50% share of the revenue from the China JV. So all put together at a gross level, we are talking about revenues of around 6,500 crores last year, including the China JV revenue. I'm not spending much time in terms of the leadership team and product lines in different businesses. I think many of you would be familiar with that. We have also added additional information on each business unit in terms of the products, the core strengths, and as well as the focus areas going forward for each of those businesses to give you a good idea of how we plan to address this business and how we plan to grow. And this time we have also included a slide which highlights the aftermarket business we have, and large number of products in this are traded, some are manufactured internally. The aftermarket business itself last year contributed close to 500 crore revenue in last year. This year it should grow further. And that has a very attractive margin profile. So we do EBITDA of close to 15% in that business, and out of that, half the revenues come from domestic and half of it is coming from export. We have distributors in number of countries outside India as well. So you see the revenue breakdown per segment. So two-wheeler contributes the maximum, followed by four-wheeler. It's about almost 70-30 kind of a share. And we have a very balanced portfolio between different regions in India as well as in exports. And this is one thing which will be key to our efforts to improve margin in the coming year. Coming to the financial performance, starting with the overall industry volumes. In Q4 last year, the two-wheeler segment in India volume declined by 21%, three-wheeler by about 2%, while there was marginal growth in passenger vehicle and commercial vehicle. On a full year basis, two-wheeler declined by 3.5%, while there was growth in the other segment. But for us, a substantial part of our revenue comes from two-wheeler and three-wheeler, which was challenge for us. But in spite of that, we were able to, when you look at the financial performance, quarter on quarter, we were able to grow the revenue by 11% sequentially and year on year by about 10%. And of course, large part of the year on year increases contributed also by commodity inflation, which we were able to pass on with a lag of 1 or 2 quarters. But that has also had some impact in the margin. So if you look at the margin development over a period of time, all the continuing operations together have a EBITDA margin of about 6.5% in Q4, which is sequentially has improved, and compared to full year also it is a better number. If we had to split up this business between India, the remaining lighting business and other business, which is in slide number 18, you will see that India continues to deliver close to double-digit EBITDA margin. So almost in spite of certain exchange loss we needed to book in this year because of the exchange rate fluctuation on intercompany loans to the VLS business. So in spite of that, we are tracking at close to 10% EBITDA margin, which is quite encouraging. And in spite of the commodity price increases and the delay in pass-through, and once the commodity price has kind of settled down and stabilized, this margin should improve further and go to close to around 11% or so. That's what we expect. The remaining VLS business, which is a combination of our electronics operations in Romania, the four-wheeler rating in India, and the global two-wheeler rating business together are almost at break-even margins right now because of capacity utilization is still not at the desired level, so which is impacting the margins. But going forward, we expect the margins to improve in the coming year. And others, which is mainly our forging business in Italy, continues to be loss-making, and we are looking at strategic options for that business as well in the longer run. But recently, we have been able to get some price increases from customers to compensate for the commodity increase as well as the energy cost increase in Europe, and that going forward should result in better margin for the IMES business as well. So at a total basis, the margin is in the region of around, let's say, 6.5% in the latest quarter. But with all the improvement plans and the growth expected during next year, we try to move towards a double-digit kind of an EBITDA margin. That's what we are targeting to deliver out of the remaining business. Okay. And the results from the discontinued operations have been shown separately. So you will see that business continues to incur significant losses, which will continue to weigh on the P&L and the balance sheet for the next quarter or two till we complete the closing. And so like we communicated after the SPA signing, so we expect the proceeds from the divestment will help us to pay off the loans we have abroad and also reduce the debt on the books of the parent, and on a net debt basis to become, let's say, zero debt company on a net basis. That's what we are expecting to at closing, which will significantly strengthen the balance sheet and enable us to invest in the remaining segments of business where we plan to grow quite aggressively. We have also given the revenue breakdown for the continuing operations in slide 17, just to give an idea of which business it's coming from. So you will see that polymer, from business unit perspective, polymer contributes almost 1/3, followed by lighting and electrical electronics business unit, and metallic and so on. Two-wheeler motorcycles still contribute, let's say, 60% of the revenue, followed by four-wheelers and then two-wheelers, scooter and three-wheelers. India is roughly, let's say, close to 80% of the revenue, with 20% coming from outside. And while from a customer perspective, Bajaj contributes a little more than 40% overall, with non-Bajaj customers together contributing close to 60%. So, and you will see that overall about, let's say, our revenues from the two-wheeler scooters, which is where the EV penetration is happening initially at a high pace. So our reliance on that is not very high. So our exposure to, so our portfolio in the short to medium term is fairly protected against the transition to EV. But you also know that we have a large number of products which are to address the EV segment, which we will be able to leverage on that once the volumes start picking up on that. So this is broadly on the financial performance. On the EV business, I mentioned we won new business with lifetime revenues of more than 1,500 crores. So this is between 4 different OEMs, both engine-related orders as well as non-engine-related components. So combination of that. That will continue to be our focus area to win new business in this segment in future. And talking briefly about our product portfolio and the kit value, slide number 26 we try to give you a kind of kit value of the components we supply for different segments. So you will see that we have quantified the amount for different product segments ranging from around 5,300 or so to the up to 110 cc segment, going up to 12,300 for more than 300 cc segment in two-wheeler. But as against that, the EV segment, we expect the kit value to be around 30,000 per vehicle. So that's the kind of value we are expecting from this segment. And in other segments like two-wheeler and the other one you will notice in the next slide is in three-wheeler EV, the kit value will be as much as 43,500 per vehicle. So that's another growth area that for us with the product portfolio we have. So in slide 28, we have also tried to give you a breakdown of the new order wins across different segments, annual revenues as well as lifetime revenues. Essentially out of the 3,500 crore revenue, 1,000 crore plus will come from EV and the balance 2,500 crores from IC vehicles. Bajaj is about 1/3. Non-Bajaj customers will contribute 2/3. So the share of non-Bajaj will continue to grow. And two and three-wheelers contribute about 2,230 crores against 1,270 crores for four-wheelers. So the four-wheeler segment is another where we are seeing a lot of traction in terms of revenue growth, which is also has a better margin profile overall compared to two-wheeler components. So I think then there are certain additional information on environment and awards and so on, which I am not talking about that much in detail at the moment. And the detailed P&L, etc. is annexed in the appendix if you want to go through. And the rationale for the divestment, which we shared earlier this month, is also available for you to look at. And a summary of the discontinued operations in the last slide, where you can see the negative impact of that on the business that continues to be significant, which will be probably a drag for another 1 or 2 quarters till the closing. So that's quickly a summary of let's say the highlights of the quarter and the year and from a financial and business perspective. So now we are happy to take questions.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Arvind Sharma with Citigroup. Please go ahead.
Hello, good evening, sir, and thank you so much for taking my question. Sir, 2 questions from my side. First, on the continuing operations in India. This EV share of around 902 million rupees that you've highlighted, that's broadly remained constant. 902 crore has remained constant since the last time you highlighted this number. Talking about slide 23. Any comments on that, sir? The expected revenue?
So the EV, the EV segment, we are saying the lifetime revenues. Are you talking about the lifetime revenues which we have showcased of 1,045 crores?
No, sir, I'm talking about the expected revenue in FY25 for the current business based on SOB industry price. That's slide 23.
1 second.
902 crores, sir.
Yes. So this is a showcasing basically the revenue which we expect, and this is from all, whether it's the electric, the EV powertrain products or the other than the EV powertrain products. So overall, that's the kind of revenue we are expecting, from the EV segment, by FY25.
Sure, sir. Sir, second question is mostly accounting related. The continued plus discontinued operations for the third quarter, which is the profit which is given at almost a loss of 2,959 million rupees, is a little different from what was reported in the December quarter. So is there something apart from just the discontinued operation which is impacting these numbers? Talking about the like-to-like numbers, third quarter reported continued plus discontinued loss versus what was reported in December. Just want to understand the dynamics of this new presentation, because it's the first time we are seeing this.
Yeah. So actually what we try to do this time, because so now that we have announced the sale of the business, and the sale of the business is not exactly the entire VLS as we were reporting earlier. It is let's say certain components of VLS which we are selling, components like the electronics, two-wheeler lighting, global two-wheeler lighting, and the India four-wheeler lighting, and China we are retaining. So that's why we try to break up the financials between continued and discontinued.
Right, sir. Sir, but shouldn't the sum of discontinued and continued operation be similar, or is there some interparty transaction there as well? I'm just comparing the two numbers, which right now is given as negative 296 crores versus what was given at negative 265 crores when you reported in December.
Right. So you will see the statement that financial statement that there is the Q3 was restated. So there was an inventory valuation error in our Morocco plant, which is a part of the discontinued operation. So that impact has been taken in Q3 now. That Q3 went up by the equivalent amount, the difference you see, which is about 3 million euro, roughly 3.4 million euro, if I remember correctly. And that is the amount which has been added to the Q3 numbers which were reported last time.
Sure, sir. That explains it. Thank you so much, sir.
Okay.
Thank you. Our next question comes from the line of Joseph George with IIFL. Please go ahead.
Hi. Is the audio clear?
Yes, it's clear.
Hi. Thank you. Thank you for the opportunity. I just have one question. What will be the effective date of the transaction? What I mean to say is, you mentioned in the call that the closure will happen 5 to 6 months down the line. What I want to understand was, in this period of 5 to 6 months, if there are cash losses in the VLS business, whose account will it fall into? Your account or the acquirer?
No. So one is that we are looking at a closure, by September, of this financial year. That's our target. But to answer your question, see, till we close the transaction, whatever are the profits or the losses, in this discontinued operations will be a part of, our consolidated results till that time. So we still own up to the results, whether negative or positive, till the time we close the transaction.
So is it possible that you may have to infuse some capital into VLS if the operational losses continue?
Yes. So in case we see that there is a need for the cash, because presently what's happening is that it's not only the chip shortages which continue in the discontinued operations. That is one reason for lower revenues, but also this Ukraine-Russia issue also has impacted volumes because of higher commodity prices and inflation, and there is a certain kind of impact on the demand. So therefore, there will be a likely possibility that we will have to infuse some amount, as per need, till the time we close.
Understood, sir. Thank you. That's all I had.
Thank you. Our next question comes from the line of Shivlal with Unique Investments. Please go ahead.
Hello, good evening. Can you hear me?
Yes, I can hear you.
I just wanted to know the quantum of foreign loss you have booked in inter-corporate transactions. And will it be for one time only, or it will be a recurring feature in the future?
You are saying for the year last year? For the year?
For this quarter 4, forex loss also you have accounted for, no? Inter-corporate loans.
Yeah, the forex loss we are accounting in EBITDA now for all the periods. So that's for the full year it was 28 crores net. In the last quarter, actually Q4, it was a small profit of about 4 crores.
But it will be a continuing feature in future?
Well,
the loan will be repaid.
It's really a function of the exchange rate movement in the sense because these are intercompany loans. These are all mark to market. So at closing, this will all get squared off. So yeah, theoretically it can move in either direction, and we are also looking at ways of hedging it to the extent possible. So.
And my another question is that how much will be the interest burden for the next year, 22-23, after this disposal of the lighting division?
See, after the disposal, the borrowings will come down significantly. Like I mentioned, on a net basis, we should become debt free. But it doesn't mean that there will not be any debt in the books at all. We will still have some borrowings outstanding. So maybe out of the 26, let's say out of gross borrowing, we have about close to, I think, 3,000 crores or thereabout. We will probably end up repaying somewhere between 2,000 to 2,200, 2,300 crores of revenue, of debt, sorry. The balance is what will remain. So you will see a big reduction in the interest cost for sure, but it's a function of how exactly we are able to, let's say, negotiate and settle those loans, and because that also will have an impact on the credit rating post closing. So once we are able to pay off the debt, large part of the debt, which will reduce the interest cost rate per se, so on. So it's a combination of all that. So yeah, but I can just say that post closing you can see a significant reduction in the interest cost. So maybe, I don't know, maybe 1/3 of the level we have now or even less could be. But it's a bit difficult to put an exact number to that at the moment.
No, I think that for last year, to give you a kind of a number for the continued operations, I'm not talking about the discontinued operations. On the continued operations, I think we had incurred about 150 crores of interest costs. And I think post this sale, probably we would not be more than 1/3 of this as an interest cost to us post the closing of this transaction, because a lot of the debt here also will get reduced, which is in the continuing operations.
But this will happen by FY23.
Yes, so we are expecting to.
During Q3 you should.
Yeah, so from Q3 onwards you will see that annual impact. But for the first 6 months, till we close, the first 6 months of FY23, till we close, obviously we have to absorb the overall interest cost. But once we close the transaction, then you will see that what I'm talking is about the continuing operations, interest cost, on an annualized basis.
Okay, thanks a lot.
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star 1. Our next question comes from the line of Noel Vaz with Asian Market Securities. Please go ahead.
Hello, can I be heard?
Yes.
Yes, thank you for the opportunity. So I just had one question. So right now, as per the slide on slide 18, it is saying that Bajaj is about 42% of revenues for FY22, right? So I just wanted to know exactly, since we are getting some four-wheeler wins as well as some other wins from the EV segment. So the portion of Bajaj to non-Bajaj, how should we see it changing over FY23 or 24?
So FY23, I don't know whether it will really change, but if you talk about the next 3 to 5 years, once we also are focusing in India on the four-wheeler side of the business, and we are also winning customers for EV products also in a bigger way, and also driving more of our global business in Europe, you will see that, the Bajaj, this percentage will go down. I don't know by how much, but it will go down to maybe it could be 1/3, because Bajaj for us is a significant customer also on the EV side. And whatever numbers you saw for 2 and 3 wheelers, but there's a full content of EV powertrain there, plus of course the other, parts like plastics or switches or LED lamps. They are biggest consumer of all our parts for the EV vehicle. So it will go down, but I would say next 3 to 5 years, I think probably Bajaj should be 1/3 and non-Bajaj should be 2/3. That's the way I would look at it.
Okay, thank you very much. My second question is actually related to your EV portfolio. So I think it runs. Yes, so it is, I think, DC to DC converter and starter motors, right? If I'm not mistaken, or am I?
No, it's a traction motor.
So yeah, traction motor. So the thing is, actually, there are a lot of other peers who are coming out with or are trying to compete in similar products. So I just want to know exactly, so how should we see this competition within these particular products going forward? Are we going to see a situation where there's going to be only 3 or 4 players competing within India within those same segments, or is it going to be still a little bit more fragmented than that?
Hi, this is Arjun. I'll take the question. In general, right, I think across the EV product lines, I think they will continue to evolve over, for sure, at least the next 3 to 5 years, right? For us, I think the way we look at it is the technology that we've looked to develop, we have developed, we feel there is clear differentiators for it. So there will definitely be segments. So the segment of the market that we are very clearly targeting really is, the kind of vehicle that a Chetak is, right? However, in general, right, if you look at the EV marketplace, it's still relatively fragmented even by performance of vehicle. So you could expect that there will be a level of fragmentation for some more time. However, of course, I think over time, as let's say the market starts to mature, I would expect the component supplies will also start to mature. And again, from a VARROC perspective, we are very confident that the portfolio we have chosen is really the most differentiated and has the highest value add.
Okay. Thank you for taking my question. That is all from my side.
Thank you. Our next question comes from the line of Rikin Shah with Omkara Capital. Please go ahead.
Hi, am I audible?
Yes, you're audible, not very clearly, but we can get it.
Okay. So I just wanted to understand regarding the patent infringement cases, while it might not be quantifiable, but what is generally the liability in cases like these, similar?
Can you please repeat? It's not so clear,
Patent infringement liability. Likely liability.
So presently, see what. So the way it works is that there are Valeo has raised a number of infringements against us a couple of years ago, and mainly it's in the German courts, and the way the German courts work is that there's a separate court which identifies even if there's an infringement of any kind, even the smallest of infringements, they will say it's an infringement. And then there's another court which kind of hears out a nullification process. So the first process is with the first set of courts would be in Germany would be okay, whether we have infringed or not, and then okay, there could be some interim some liability, and but then according to us, all these patents are actually quite frivolous in our view, and they will not stand, when it comes to nullification, it will not, it will not stand, on its feet. But the only thing is that between, the infringement which is granted by the court and nullification, the gap is more than a year, So till then, is something which you need to kind of deal with. So what we are also parallelly trying to see that whether we can reach some kind of a reasonable understanding, with value in this regard, so that we don't really have to, unnecessarily kind of spend more on, in legal expenses and other things, and also settle the case, forever. So we are also in discussion with value to see whether we can settle and come to a reasonable number, which would be in a single digit, kind of in million euros. It would be in a single digit. So let's see how that goes, So of course the court proceedings are going on, but at the same time parallelly we are looking at some kind of a settlement also with value. Let's see what works out. So if something reasonable, we will settle.
All right. That's all from my end.
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star 1. Our next question comes from the line of Deepak Pawar with Vasuki India Fund. Please go ahead.
सोबत बोलत आहात त्या व्यक्तीने आपला कॉल होल्डवर ठेवला आहे. कृपया लाईनवर राहा. The person you are speaking with.
Hello.
Hello.
Ladies and gentlemen, the caller has kept the line on hold. I will be taking the next question. The next question comes from the line of Abhishek Jain with Dolat Capital. Please go ahead.
Thanks for opportunity. Sir, how much is the total debt if we include the discontinued and continued operation?
On a net basis, so we are at about 2,600 crores. On a gross basis, it's close to 3,000 crores.
2,900.
Yeah.
So 2,900 crores on a gross basis and 2,600 crores on a net basis. 2,650 on a net basis.
And a continued operation, total debt is around 1,600 crores, right?
Continued operation, see, when you say continued operation, you need to see India plus overseas, but
yeah,
that is about, let's say 1,400 crores, but that also, part of that debt was taken to finance the lighting system business. So in that sense, it's not showing up in discontinued operation, but it is really to fund the lighting system business. So if you look at purely funding for the continuing operations, that's what I said, it will be much lower. So maybe in the region of 600, 700 crores maybe all put together. So that's why once we have the closing and the sale process coming in, you will see this figure coming down sharply here.
So majority is for the discontinued operations, whether it is in any entity, whether it's in India or it's in overseas continued operation. Largely, a lot of the debt has been taken to fund the VLS operations over the last couple of years. So what we are saying is that out of this 2,900 crores of gross debt, about 20 to 2,300 crores at least would be, towards the VLS, kind of, business, and the balance would be more for the, India and a little bit of maybe other businesses abroad.
So you have raised around 4,700 crores from this deal, and your total debt is around 2,700 crores. Plus there is some adjustment because of the working capital. So most probably you should be the net cash company after this deal. But you are talking about that debt will continue to be there around 8 to 9 billion in the books. So can you explain it entirely?
Yeah, on a net basis, we will be cash positive on a net debt basis, but that doesn't necessarily mean that we will repay 100% of the existing borrowing. Some of the existing working capital financing, etc., which is at a lower cost, will continue, and we will prefer to preserve some liquidity to be able to fund our investments in the growth areas we have identified, both EV related and otherwise.
So if we consider the cash and cash equivalent, then what would be the position in FY24 end about our cash on the cash or the net debt?
On a net basis, at closing, we should become surplus. That's what we have communicated. So beyond that, we expect to maintain that status going forward. So it shouldn't be any materially change. So parallelly, we are also working on the long-term strategy for the India business or also other parts of the business. So if as a fallout of that, if we decide to make any significant investments, at that time we will update in terms of anything. But we still expect to end the current financial year on a net cash basis.
Okay. And what would be the capex for the next 2 years? Because the order book is quite strong, and as you said that around 1,000 crores order is from the EV side. So in that case, you need huge capex going ahead. So can you throw some light on the capex plan for next 2 years in the continued operation?
So we would say that, because the India side, I think we have made quite a bit of capex in the past, but still I think we will need to make capex of at least around 200 crores here. And then, for the other businesses, whether it's your two-wheeler global lighting or the electronics business unit abroad, or for the India four-wheeler lighting, overall, I think probably we would be looking at, another probably 100 crores of investments. So we can say, let's say, for the next couple of years, I would say for the continued operations, we would look to invest about 300 crores, each year, to kind of have this kind of, growth which we are aspiring for, which is at least about 8 to 10% more than the market growth.
And what would be the asset turnover of this capex?
Yeah, typically the asset turnover for us, depending on the segment, ranges from 2.5 to 3.5. So that's typically the kind of. So on average, you can take maybe around 3.
So from the existing business, I'm talking about only continued operation. What would be the peak revenue, and what is the current capacity utilization? Only from the continued operation.
On the continued operation, you're talking about capacity utilization.
What is the current capacity utilization, and how much peak revenue can be achieved from the existing capacity only?
You're talking about for the full continued operations?
Yeah.
I think that we could, if everything goes well and the market is kind of good, we could be looking at least about 8,000 crores of revenue from the continued operations with the current capacity.
Despite that, you are doing the capex of around the 300 crores each year, I mean to 900 crores the next 3 years.
Yeah, so I think that's an investment we will make, but I think initially the investments are a little bit higher, I would say, for the the business other than our India business of 200 crores. For the next 2 years, it could be 100 crores, but then we don't have to invest so much going forward, even for a double-digit kind of a growth in those markets. But yes, the next couple of years, it would be 200 plus 100.
Okay, got it. And sir, out of the 5,800 crores kind of the revenue, what was the revenue contribution from the two-wheeler international business and the India lighting business, four-wheeler lighting business?
I think that we had shown it in that initial slide to you. Can you just go there? The initial slide you had shown, no? In the beginning. Yeah, so basically, as we done 1,500 crores. So a lighting business, which was basically the what is the, I can't read it.
No, 21%. It's a combination of global two-wheeler lighting plus India four-wheeler lighting.
So the way we have shown it, if you see slide number 8, we have shown that the India four-wheeler lighting and the global, two-wheeler lighting business is 21.4%. That includes also the India two-wheeler lighting. And then you have, the polymer business, which is at about 33%. And you have your electrical and electronic business in India, which is about close to 20%. You have the metallic business, which is all your engine valves, gear, all the IC related, mostly that's about 12%. And you have that IMES, that forging plant in Italy, which is 5.1%, and your aftermarket is at about 8.5%.
So what would be the part of the VLS revenue in total revenue? If I talk about the earlier two-wheeler lighting was the part of the VLS, plus the India four-wheeler was also part of the VLS, which has not been sold yet. So if I talk about the only that revenue, what is the quantum?
So that is the one which I said was 21, the lighting itself as a whole would be 21.4%. That's what we are showing.
Okay, so it is more than the 1,000 crores kind of revenue.
Yeah. It will be more than 1,000.
Okay, sir. And so what kind of the margin expansion you are looking from overall business only from the continued operation for the next 2 years?
So see, we are going to be striving to achieve in the next couple of years, an EBITDA margin of, closer to 11.5 to 12%. And that is something we are very confident about, especially, so India is something in the next 2 years we would like to achieve a 12% EBITDA. That's what we are striving for, because we have a lot of business already, and with a little bit of market support, I think we can achieve that 12%. And in the other businesses, I think everything else, I think we can look at about, we would like to strive for closer to 10% EBITDA, a double-digit EBITDA. That is going to be, what we are going to be looking at. But India is going to be probably 80% of our revenues, and the balance will be about 20% of our revenues. So that's the way we're looking at it in the next 2 years, that this is something we need to achieve, that we will achieve.
But as you mentioned that around more than 1,000 crores is coming from the international business, international lighting business from the VLS, and that is the low margin business. Plus there is an incremental revenue from the E2-wheelers around 1,000 crores. This is also a low margin business. In that case, EBITDA margin expansion of around 500-600 bps is possible. If possible, then what would be the key growth drivers?
See, basically the way I see it in the foreign businesses, whether it's an electronics business unit which has just started and the revenues will we really see in the coming year, I'm talking about the Romania business, and that's going to be a double-digit EBITDA in the coming year. We're also looking at an overall global two-wheeler lighting business, to be at about 10%. Then the India four-wheeler lighting business, I think this year we can expect 8%, and then going to the next year 10%. And our India business, the major business, here we expect it to be 11.5% in this year and probably 12% in the next year.
Okay, sir. Thanks, sir. That's all from my side.
Thank you. Our next question comes from the line of Pawan Parak with Renaissance Investment Managers Private Limited. Please go ahead.
Sir, just one question. What is going to be the cash burn in discontinued operations until we consummate the deal?
So frankly, we are not really expecting too much of a cash burn over here. We are looking at kind of seeing that how we can really mitigate this kind of a cash loss. So we are taking already a lot of measures, of a project raise, which is continuing kind of aspect. We are also, which means basically streamlining the operations, the scrap and all, especially in the new plants. Because the current plants, we don't have an issue, as such. But yes, there could be some cash burn. We don't know the estimate because it's month to month. We have to see really based on the volumes because of the chip shortages, and also the Ukraine issue, largely more in Europe. I would say the European perimeter, which is the major perimeter. Here, it is very difficult to really predict what is going to be a cash burn. But I think whatever is a question of another few months, that's something we will finance. But we don't expect it to be some kind of a major cash burn over here. There could be a small cash burn. That's something we will finance.
Okay. So what was the cash burn in Q4?
The Q4 cash burn was how much about?
I mean, in the region of 10 to 15 million euros roughly.
About 10 to 15 million euros. About 10 to 15 million euros.
Okay. So basically, when you say small cash flow, means like 10 to 15 million euro for 2 quarters, which means like 27 million.
No, we are talking about...
going forward, see, what we are seeing is that the revenue sequentially is improving quarter on quarter, because the main issue so far has been on the revenue side, because of the semiconductor supply shortage situation. We were not able, capacity utilization was an issue, and now that issue is getting improving, like sequentially we are improving the revenues. So we expect this quarter and next quarter to have, I mean, it is still not fully normalizing, but still coming to a reasonable level of capacity utilization, which is why operationally we expect the cash flow to come close to break-even level. So it could be, and on top we are also getting price increases from customers to compensate for the commodity cost increases and the energy cost increases we have had in the last few quarters. The combination of that, we expect the business to be operationally come close to kind of break-even free cash flow. That could be, and the main financing requirement will be related to certain loan repayments which are coming due between, let's say, in the next few months. That will be in the region of 15 to 20 million euros between now and, let's say, closing, that number or so, which we have to finance from the parent company, and a little bit of incremental operational funding depending on how the revenues.
Yeah, a few more million euros probably may be required. We have to keep that, But it's not something like significant what we have seen in the past. We don't expect that to happen.
Okay, sir. Thank you so much.
Thank you. Our next question comes from the line of Basudev Banerjee with ICICI Securities. Please go ahead, sir.
Thanks, sir. A couple of questions. One, to continue with the previous question, like 6 months from April to September is not a small time. It's almost half year. So on a general basis for VLS for full year, capex used to be almost 700-800 crore. So in this 6 month period, what is the capex VLS will be doing? Is that subdued significantly, or it is normal? That will also define the quantum of cash burn. So from that angle, if you can highlight.
Yeah, I don't think that, I think presently we are not really spending more on capex because we already have a lot of investments in place. We underutilize on our investments, and so the moment we are not really doing much of a new capex. Presently for the last, I would say from January onwards, our capex has been only towards past payments. We have not been investing in new capex at the moment.
Sure. And second question, sir, if I look at in your presentation, slide 17, where you have highlighted segmental profitability, which is very useful. Where roughly if I see FY21 and 22, both the years VLS remaining operation operated hardly at 1%, and similarly IMES Italy minus 9% in both the years. So broadly, one can see that the loss of IMES might get balanced out by either EBITDA profit of VLS remaining, and residual EBITDA is only from India operations. So 1% moving to almost 9-10% as you mentioned, and minus 8-9% moving to plus 5-6%. If you can explain the journey, nor is IMES stake sale is also up in the grabs sooner than later, because double-digit EBITDA loss-making entity taking away a significant part of your residual EBITDA.
See, the way I see, frankly, for FY23, the EBITDA margins I expect, in India would be closer to 11.5%. That's my expectation. Sure. And on the VLS remaining operations, I would expect it to be closer to 10% in the coming year. And EMS would be in the range of probably from a minus 8.7%, I would say in the range of 4%, 4 to 5%. This is what I am looking at for FY23. EMS, why it's coming to profitability is because recently we have got the price increases from our customers in this business towards gas prices as well as towards raw material price increases and general price increase also. So therefore, I think we'll be better off also in our other operations, the EMS side also, in this coming year.
And sir, VLS India four-wheeler lighting operations, how is the profitability?
That will be around 8% in this year, but then next year we are targeting 10.
And similar to the gas price and other raw material contract changes, what you mentioned for IMES, how one should look at VLS remaining operations margin moving from 1% to 10%?
Yeah, so I think this VLS remaining of this 1%, has got a lot of noise around it, the last year. I don't want to get into it. But the business, if you see the VLS remaining operations, largely, I've only told you about the India operations where we expect it to be, at about 8%. The other two main businesses are the two-wheeler lighting businesses, which has got plants in Italy, Romania, and in Vietnam. Now, Vietnam is doing very well with a high level of EBITDA because it's got the revenues, and it's already doing a very good double-digit EBITDA. When it comes to Italy and Romania, the issue today is the capacity utilization. So that's something, where, we're looking, to see that we're able to, in that region, at least touch about 7-8% for the Italy. So overall, I think we will be at a 10% level for our two-wheeler lighting business at least, And then the EBU, now we see the sales coming in. They've not really had any sales, the Romanian electronics business unit. So there also we see, revenues, coming in at about 25-30 million in this year, and we're looking at a double-digit EBITDA also in our Romania electronics business because this year at the moment we're supplying all these PCBAs, lighting PCBAs to VLS, which will then be PO, So therefore, overall, we are quite confident that, because we have the businesses, the business have been taken at good prices. So, it's a question of better utilization in some of these plants like Italy and Romania. And I think with a better utilization, you will see a double-digit EBITDA in these places. It's not really a problem.
So, sir, from a previous question regarding that inventory adjustment for Morocco plant, which got accounted later on. So, initially, if all of VLS was going to get hived off or sold, so why these partial operations still you are keeping, or you have kept them on visibility of major turnaround and capability, or Plastic Omnium didn't want those operations?
See, what we have kept out of VLS is about two-wheeler lighting global lighting business, which is anyway a core business. So that's something which we would not sell, and nor were they interested because they're not in the two-wheeler line anyway, and we would also not sell. So that is very clear. On the electronics business unit, we have kept it not only for supply of the lighting PCBAs. We have also developed our own future technologies on the light engines or the light control units, which can supply to a lot of the other lighting players, independently. And that's a future technology. And also we are developing at the moment the internal external cameras, which are the ADAS products, which has got a very good market, especially in China and India, other than Europe. So we are focusing, so the electronics business unit is also something which is core to us, And electronics as a business unit is not lighting. This is a high ROC business, a good margin and a high ROC business. And electronics is something which we have chosen to be, for us, as a future growth item other than the two-wheeler LED lighting and EV products, So this is also going to be a core business for us, moving forward, the EBU, which is in Romania, other than the two-wheeler lighting global. So and here the margins are good, so we are not too concerned about margins going forward. Presently, the margins have been impacted, more because of capacity utilization I would say, in these plants. Romania is a new plant. Italy plant has been challenged by some of the capacity utilization. With a better capacity utilization at 60-70% is a PAT positive plant. The Italy plant. So these two businesses, anyway, we want to keep. India four-wheeler lighting is our market. We wanted to keep the India four-wheeler lighting business because it's a market we understand. Here, whether they are global four-wheeler lighting companies, OEMs, or there are Indian OEMs, we have a good relationship. We do other parts also, like plastic parts or some of the other engine parts. So we have old customers here, and here we're very comfortable, in doing business in India, being our market. So we wanted to keep this. It was our choice to keep this business, and here we have a non-compete arrangement with Plastic Omnium, for 5 years, and which would also continue further. And we have all the latest technology agreement also. So whatever the future technology which come in also will be, will be there for India. When it comes to China, frankly did not get sold because it's a JV. So because it's a JV is something which, companies were not interested in buying. PO was not interested because of the JV. Going forward, once we have a solution for China, we will see what to do, But presently, PO was not interested in actually buying into a JV kind of a thing, They wanted to be independent.
Sure, sir. Thanks.
Thank you. Our next question comes from the line of Deepak Pawar with Vasuki India Fund. Please go ahead.
Yeah, hi. Am I audible?
Yes.
Yeah, thank you for taking my question. My question would be on the electronic components or parts on two-wheelers and three-wheelers, which we are expecting 30,000 rupees on two-wheelers and 43,000 odd rupees on three-wheelers. So what would be the EBITDA margins that you expect? Any ballpark figure on these kits?
So I think it would be double digit, depending on the product, because some of the the more expensive products like motors, which are at least 8,000 to 10,000 rupees. Some of the bigger components you could have probably a lower EBITDA, maybe 10, but comes to the smaller products. So it will be anywhere between 10 to 15% is what we look at a range for depending on which EV product we are talking about. But that's something our EBITDA margin one anyway needs to have for the kind of investments we have made, in this business. Not only on capacity, not only on capex, but even on the engineering side. There's a lot of money invested here,
Right. Yeah, that's all I wanted to know. Thank you for taking my question.
Thank you. Our next question comes from the line of Arvind Sharma with Citigroup. Please go ahead.
Good evening, sir, and thanks for taking my question again. Sir, just a quick clarification on the revenue guidance that you gave of 8,000 crores. What's the timeline for this?
So the 8,000 crores is what we can do in the continued operation. That's a capacity. That's the minimum we can do. But it all depends on the market conditions. But what I'm saying is that we have done about 1,500 crores last year in the continued operation. We will do always 8 to 10% more than any market growth. That we are very confident of doing. So it will be 8 to 10%. I don't want to put a number there, but it will be 8 to 10% more than what if the market goes at 1%, we will go at 10 to 11%. If it goes at 5%, we will go at 14, 15%. So that's what I'm saying. That we are very confident of with our whole product portfolio, which we possess.
Sure, sir. And I believe that includes the new EV orders as well.
Yes.
And sir, just to rehash the margin numbers, the consolidated business margin aspirations are 10%, which includes 11.5% for India and 10% for the remaining part of VLS. Is that the right number, sir?
Yes. So like I said, we would like to have 11.5% for India, but in India, the four-wheeler lighting business, we are not looking at more than 8%. And then the other businesses, we are looking at 10% abroad.
Sure.
For FY23.
Right, sir. Sir, just I know you clarified on this, but just to be very sure, When you talk about the India operations revenue in the group performance, India and VLS remaining, India operations revenue include EBU, MBU, but do they also include the four-wheeler lighting business in India, which was earlier part of VLS?
No. Four-wheeler lighting at the moment comes in the VLS remaining operations.
Remaining. Got it, sir. Thank you so much for the clarification, and that's all from my side. Thank you, sir.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to our management for closing comments.
Thank you. I just want to thank everyone again for joining us, listening to us, and asking your various questions and queries. The trust and faith of all our stakeholders is what motivates us to pursue excellence in our day-to-day life. And thank you very much in showing confidence in us over these last few years especially. Thank you.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
Thank you.